Good morning, everyone, and thank you all for joining us today for our webinar. We've got a packed house today. If we were in a live conference room, we'd have over 1,000 people that have registered for this event, so thank you all for coming. We do still see a few folks getting online and getting into the waiting room there, so we're going to give it another few seconds to make sure that everyone gets settled before we get started. All right. And with that, welcome everyone. Good morning, good afternoon. Welcome to today's webinar brought to you by Natural Gas Intelligence and Yes Energy. Power Struggles, Assessing Seasonal Price Drivers and Energy Market Volatility. I'm Leticia Gonzalez, Managing Director of North American Natural Gas Pricing. And joining me today is Alex Bennett, Product Manager for Yes Energy. So we do have a full agenda today that we want to talk to you about. I won't go through every bullet, but really the goal of our program is to provide you all with a high-level overview of the natural gas and electricity markets. Now, we are getting coming out of the summer season, and so that is a peak season for the electricity market and also for a couple of natural gas markets. And yet here we are with commodity prices for both electricity and natural gas sitting near historic lows. And so we wanted to talk to you about, some of the supply demand factors that are driving that price behavior. Now, for the second part of our presentation, though, we wanted to focus on two regions that aren't necessarily following the general trend, and that's West Texas and the Northeast. But first, a little bit about NGI. Natural Gas Intelligence is a price reporting agency and a trusted information source in the natural gas market. We have a variety of natural gas price data and other data that we provide our clients to help them make informed business decisions. And so you'll be hearing me talk a little bit about those prices throughout my presentation. Alex, I'll turn it over to you to give us a high-level overview of Yes Energy and, of course, our partnership.
Yeah, so a little bit about Yes Energy. We offer the most accurate and reliable market data, forecasting, and modeling solutions. We provide better delivery of this robust market data in a format that suits your needs, whether that's through web-based analytical tools or accessing our data warehouse through APIs or our cloud-based database. Our comprehensive solutions are end-to-end, and we help customers transact with the market through trade settlement with a suite of tools allowing submission, tracking risk, and calculating performance. Within the Yes Energy platform, our market data appears seamless, but it represents an extensive catalog from many different sources. That starts with public power market data from ISOs, other public data from sources such as the EIA, our premium data sets such as Live Power, and partner data such as NGI, which brings me to our partnership. For the benefit of our mutual customers, Natural Gas Intelligence and Yes Energy partnered 2 years ago so that NGI data would flow through Yes Energy and the tools our customers already use. And the reason we partnered is because our customers asked for it. Yes Energy supports NGI history back to 2004 and provides access to over 160 daily price indexes for no additional cost. Now, Letty and I are going to get into the gas and power macros, but we would encourage everybody to submit questions in the chat, and we will get to as many as we can at the end of the presentation. And for any ones that we don't get to, we will be following up with you afterwards. And now to the gas macro fundamentals with Letty.
Yeah, thank you, Alex. So as I mentioned in my opening remarks, prices in the natural gas market have been hovering near historic lows for much of the year. Looking at this chart, you see Henry Hub prices in the dark blue. Henry Hub, of course, is the US benchmark. And so you see in January, mid-January, we did see a brief price spike to around $13, but that's it. The rest of the year has been pretty flat. We've been kind of hovering in that $2 range for most of the year. And really, I picked a couple of other locations that are key in the United States, but you're seeing that same general trend. The Chicago City Gate, where NGI is the index of record, same thing, brief spike in January, but generally speaking, we see lower prices throughout the rest of the year. Same thing in Southern California at the SoCal City Gate, another NGI index of record, spike earlier in the year, and then generally flat later on through the rest of the summer to now. Now, I'm not going to get too far into the weeds at Waha. That is, we are reserving that for the latter part of this presentation. But I do want to point out that we do see different behavior taking place there, with negative pricing occurring as early March, which actually is still the part of the traditional winter season in the natural gas market. So let's take a look at some of the factors that are actually driving prices. On the demand side of things, what I think is really interesting about the low natural gas price environment is that this has occurred even in spite of record power burns this summer. And you heard me correctly, we've actually seen record power burns this summer. And that's in spite of a rampant growth in renewable energy, namely solar. But what I think this chart shows is the importance of natural gas in the energy supply mix. Because what happens is when that renewable energy does not show up, like it didn't on July 9th, this is what happens is you get this huge spike in natural gas demand. And so just to put it in perspective, on July 9th, we saw wind generation averaging or totaling only 0.3 million megawatt hours. Now, this is down an entire 1 million megawatt hours from where it averaged in June. So it has a huge impact on the generation stack when that wind generation doesn't show up. And as you can see, we hit a record for natural gas power burns for the second year in a row, actually. Now, on the LNG side of the equation, obviously LNG has been one of the major drivers in the natural gas market over the last several years, and it's expected to continue being a major source of demand for the market in the coming years. But however, this year actually kind of proved to be a little bit of a disappointment for natural gas. You do see at the beginning of this chart here that utilization at the US LNG facilities was high. That's not unexpected, especially, during the winter season, we've got these facilities that are running near their full capacity. And then as we get into the spring season, we see that capacity and those feed gas volumes start to decline. Now, this too is not unusual. We typically see these facilities go offline for planned turnarounds during this time, since we don't have a lot of cooling demand yet. And then we're, kind of the heating demand is starting to dissipate. But what we didn't see happen during the summer is that we also didn't see volumes recover. We didn't hit anywhere close to that 14 plus BCF per day mark that we had hit earlier in the year. And some of that is, as I mentioned, because of planned maintenance events. But then a large part was also because of persistent operational issues at Freeport LNG, which I'll let Alex talk to us a little bit about too. More recently, we've got Cove Point LNG that is now offline for its maintenance event. That happens every September, so not a huge surprise. We're, out of the core summer months, and so we're heading into that shoulder season. Now, that said, it's not all doom and gloom on the LNG space. We do have Plaquemines LNG that is in the early stages of commissioning, so we're starting to see some incremental volumes flowing to that facility. And Corpus Christi Stage 3, that expansion is progressing on schedule, and so we are expected to see some initial volumes or incremental volumes flowing to that facility as well. Now, looking at supply factors, let's first take a look at production. And for the purposes of this presentation, I wanted to go back to 2020 because I feel like that you can really appreciate the response that producers have had to the natural gas prices, and that means responding positively when prices are high, and then the opposite effect when prices are low and reining in that output. And so, as you can see here, obviously in 2020 we had COVID-19 that really dragged down the economy, so you had production really low in the low 90s bcf per day. And then we started to see an incremental recovery start to take place in 2021. And then in 2022, we had a huge jump in production. Now, that was in response to really high natural gas prices here in the United States. We did have Henry Hub prices shoot to around $10 during the summer months. Now, that's not only because we had a hot summer, but that's also the year that Russia invaded Ukraine. And so you had a really strong response from the producers who ramped up output in order to boost LNG, in order to accommodate rising LNG demand. Now, heading into 2023, we saw another jump in production. Obviously, the call on American LNG remained high. And again, we had another record hot summer here in the United States. So production levels held strong and even remained so heading into 2024. And in January of this year, we actually saw production hit over 106 BCF per day. Now, of course, that's not where it's averaging. That was just the peak, the height of where we saw it play out this winter. But just to say that we did have strong production at the beginning of the year. Now, we didn't have a winter though. We did, as you recall, have that mid-January winter storm that came through the US and drove up prices, but it was short-lived. And prices cratered shortly thereafter. And really, February, they were calling for a cold February, and that didn't pan out. And so prices ultimately fell. And so very quickly you saw that, the winter season storage inventories were going to be at healthy levels, and we didn't need all of this production in the market. And so we saw a very swift response from producers that said that they would curtail their output. And so Chesapeake Energy, EQT, those are some of the big ones that started curtailing. And EQT, for its part, just as recently as its second quarter earnings call, did say that they plan to keep production curtailed through the fall shoulder season. Even with the reduction in output that they've had so far this year, storage inventories are still fairly high. And so there's no need to really start bringing back production yet. Now, that's not to say we don't expect to see some growth. We do expect production to slowly start coming back into the market, especially as we start getting some of that colder weather coming in. But really, the biggest thing that we'll be focusing on is 2025, when we really start to see whether or how producers respond to prices. How is the winter going to play out? How is LNG demand going to take shape? And so 2025 is when we're really going to start seeing how producers respond to the newer price environment. Now, when we talk about supply, we need to talk about storage, obviously. Now, going back to the start of this spring, the gas market, and as I mentioned, we didn't have much of a winter. And so the gas market was sitting at about 2.26 TCF in the ground. This was 422 BCF higher than the prior year and 633 BCF higher than the 5-year average. So huge surplus in the market. But look at where we are today. Yes, we are still above historical norms, but really that surplus is down to only 127 BCF when you compare it to last year, and about 190 BCF compared to the 5-year average. And so I think that this is something that the market isn't really paying as much attention to as I think it should, in a year in which LNG demand really wasn't as strong as it could have been. We've managed to whittle down that surplus. And so, now that said, we do have some stronger injections likely on the way. We are entering the shoulder season. For most areas of the country, temperatures are pretty moderate. Here in Texas, where I am, it's still pretty hot, but it's not as hot as it was this summer. And so we should start to see injections ramp up here in the final weeks of the injection season. And so, of course, if you'd like to know more about where analysts are pegging storage inventories to as we head into the winter time, I invite you to click that top button at the top right, where you can gain a free trial to NGI's all news access. And so that is where our market stories will lay it all out for you. There's obviously a lot still that we need to keep our eyes on as we head into the winter season. So taking a look at the forward curves, we didn't get into the specifics into the long-term outlook for natural gas, but just taking a look at the forward curves here, we obviously know that we've got a substantial amount of demand coming online by way of, LNG. We've got Plaquemines LNG and Corpus Christi stage 3 that are ramping up. We've got other LNG projects in the works as well. And so altogether, we've got a significant amount of demand coming, even by the end of this decade, somewhere around 28 BCF per day that we'll have online just from LNG by 2030. And then we haven't even gotten into data centers. Data centers, we could probably devote an entire webinar to, but the jury is still out on exactly how much demand, natural gas demand, data centers will bring to the market. But even kind of taking a middle of the road approach, so anywhere from like 5 to 6 BCF per day coming from data centers. When you lump that in with LNG, we're talking upwards of 30 BCF per day of gas demand that wasn't even in the market in 2015. So this is a monumental change that we've seen take place in the industry. And yet, if you look at the forward curve, yes, don't look at the Northeast. We can get to that later. But if you look at the forward curve, and in particularly the Henry Hub, you're not really seeing a huge improvement in prices. You're seeing prices generally in that $3 to $4 range. Obviously, some seasonal volatility taking place, but still with considerably low prices. Oh, and I should note too, wanted to point out if that our forward curves, our NGI forward prices are not available on the Yes Energy platform. So I do invite you to click on that QR code to request a trial for that. And with that, I'm going to turn it over to you, Alex, to get us started on the power macro outlook.
Thanks, Letty. For power, I'm going to cover some market change, and specifically, I'm going to zoom in on solar, briefly touch on batteries, and then move over to load. Now, for the first couple of slides, I'm going to run through these at a pretty fast pace. And solar generation capacity has exploded the last 5 years. So leading gen type built represents about 40% or 69 gigawatts of capacity additions the last 5 years. And below, I've listed it out by ISO region from EIA 860 monthly data. Key takeaway here is that Texas and California are far ahead of other ISOs, and they may provide a view into solar's market impacts that could be coming for other ISOs as they build out solar generation. For the next slide, just how fast is solar coming online? This graph is showing ERCOT daily peak hour solar generation average for the month for the last 6 years. In August 2019, we had a 1.6 gigawatt peak each day. And by July 2024, that number ballooned up to 19.1 gigawatts. So with all that solar rolling onto the grid, something has to ramp down, and that's our thermal fleet, which is seeing more frequent daily cycling. Here we're looking at average generation shapes for coal and combined cycle facilities. This is 2019 in the dashed line and last 12 months as a solid line. So for CCGTs, graph on the left, in the middle of the day, we're seeing a lot of downward pressure from solar. Now, load growth has pushed sundown generation up in the morning, and we're seeing CCGT peak at higher levels at the end of the day whenever solar rolls off the grid when the sun sets. For coal, it's getting left behind. So coal is showing the same shape as combined cycle facilities, yet it's well below 2019 levels. I will make a note that ERCOT did retire 1.4 gigs of coal between 2019 and the LTM. And there's a ton of other factors that I won't touch on that are putting downward pressure on coal. But solar is just another one that's putting downward pressure. So we're moving to California now, which has equal grid scale solar and a lot more behind the meter solar compared to ERCOT. Yet CAISO has much lower load levels. So solar makes up a larger share of load. What's happening as a result of that is that on-peak power prices are getting crushed. I'm going to take some time to explain the graph on the left because the next two slides are going to utilize this format. This is the April-May average hourly load shape in black, net load in dotted blue, and renewable generation shaded in green. Now, net load is load net of renewables. It's the reason why this graph stacks so nicely. So the black line minus the shaded green is going to yield our net load, and it represents dispatchable thermal capacity. This is an important thing in price formation. So now let's play out the day. So as the sun rises, net load is tanking down to levels as low as 3 gigs, which is extremely low. In order to prevent thermal units from shutting off, the market counteracts this with solar curtailments, exports, and battery charging. The reason it does that is because when the sun sets, these thermal units are needed to fill the gap whenever solar rolls off the grid, and thermal units can't just turn off and on in the middle of the day. The price implications from these low net load levels are crazy. And on the right, I'm showing on-peak heat rates. This is the power price divided by the price of gas, which is a normalized view as power prices can vary widely depending on. From 2020 to 2023, we saw slow declines. And then in 2024, power prices are negative for the April-May average in the real time in California. So solar is shifting things around in the market, and it's potentially shifting volatility to the winter. So I'm keeping the same two graph types, but now I've switched over to ERCOT, and we're looking at average summer and average winter load and net load shapes. So in the summer, solar is a great pair for summer grid operations, and hotter days are theoretically going to see near maximum solar output. If you compare the load levels and net load levels between these two graphs, it may be hard to believe that winter could see increasing volatility. But I will kind of break this down and make some key points with these graphs. In the summer, obviously load is much higher, net load is higher. But when load is peaking and net load is peaking is very important. So solar is shifting the net load peak away from the demand peak. So demand is peaking at hour ending 18, yet net load is not peaking until hour ending 20 or hour ending 21. In that time, load is actually cooled off about 8 gigs, which is creating a little bit of a buffer on the system. Another takeaway is that there's a lot of renewable generation during this peak demand hour. And hotter temperatures are going to pair better with more wind generation and more solar generation, i.e., we're going to see more green in the summer. Let's contrast that with winter. In the winter, the demand peak is not in the afternoon. It's not whenever the sun is up. Instead, it's in the early morning hours whenever the sun isn't up, it's the coldest, and we see no solar generation. The result of that is that our net load peak is now lined up directly with the demand peak. So we do not have a buffer like the summer. Another thing is that in the winter, we have to face this net load peak now twice in the day. So it ramps up to its first peak in the morning, solar rolls onto the grid, and then at the end of the day, when the sun sets, we are seeing a second net load peak. Lastly, during the winter, cold weather means lower wind generation. The winter season means the sun angle is resulting in reduced solar output. And so the total result of that is less shaded green. So now I've got the same graphs and I've swapped out the average summer and winter generation shapes with the tightest summer day on the left and the tightest winter day, which occurred during Winter Storm Heather on the right. Things now look a lot different. Our net load peaks are similar, yet with much less load levels in the winter. You can see on the left that for summer, renewables are crushing during the demand peak and shifting the net load to a later time in the day whenever demand has fallen. In the winter, we're seeing the two net load peak happen twice in the day. And also, renewable generation is almost zero during the second net load peak. Now, on this day for Winter Storm Heather, ERCOT actually significantly over forecasted load. That's a whole separate discussion, but that's part of the reason why energy traders buy Tesla forecasting data offered through Yes Energy. So if load levels were much higher for Winter Storm Heather, this could have been a much different situation. The grid excelled during Winter Storm Heather, but even as much as 5 gigawatts more load in the morning could have resulted in a different outcome. Lastly, for winter, we've seen that it has the ability to impact natural gas deliverability. And this has been seen with Uri and SPP and ERCOT and Elliott for the Northeast. So batteries are starting to burst onto the scene, and they've got generation characteristics that can offset some of these solar impacts. The graph here is looking at hourly average battery gen in CAISO for the last 12 months, LTM. In the middle of the day, batteries are charging. So they're increasing load, reducing thermal down ramp, as well as reducing solar curtailment. When the sun sets, this charging flips into discharge in the peak net load hour, with CAISO averaging 4 gigawatts in that peak net load hour. So as a result of solar rolling off the grid in this sunset hour, it's created a fast demand ramp on the system. For traditional thermal units, this has resulted in peaking units seeing higher utilization. But batteries are well positioned with much faster ramping capabilities versus peakers. The graph I have here is showing the 1 hour net load ramp shown in the blue bar. And this has grown to 5.7 gigawatts in the peak net load hour. This is almost double from 2020 levels. Yet I created a second calculation in light blue. This is our net load 1 hour ramp, but I'm subtracting out the battery discharge. This is showing a different picture where net load less battery discharge has actually remained flat and batteries are filling the gap that solar generation is creating whenever it rolls off of the grid, and especially growing solar generation is creating. These unique battery generation characteristics do come at a price, and in ERCOT, batteries have been offering at ultra high energy levels. That trend did start to cool off this summer. This chart below is summarizing every single real-time battery offer in ERCOT SCED for the last 18 months. In simple terms, I bucketed these offers and averaged them for the month for offers below $200 in green, and dark red is offers near the $5,000 price cap in ERCOT. From September 22 to about the start of 2024, we saw the majority of battery capacity being offered at or near the cap. But in 2024, growing battery capacity saw a abundance of energy offers flood in below $200. So our green grew to where in July 24, we saw 1.2 gigs of battery capacity available under $200. A key takeaway here is that batteries will likely be expensive in the short term for other markets, but as capacity grows and they start to saturate the market, we will see more competitive offers and lower energy offer levels as a result. This is what's seen in CAISO, which has a majority of its battery capacity offered near $100 a megawatt hour, which is a stark contrast from the situation in ERCOT. This is just the tip of the iceberg. Texas and California are providing good examples in markets where battery and solar penetration has reached higher levels compared to other markets, but there are a lot more additions coming in the next 5 years. Solar in orange is continuing to lead the way with 89 gigs in the pipe. That's 50% of projected capacity additions. Next highest, batteries, which is at 41 gigawatts. The combination of solar, wind, and batteries from a long-term look creates a somewhat bearish view of markets, but load growth could throw that all out the window. ISOs are currently sounding the alarm on immense projected load growth from electrification, data centers, and more. On screen, I've got ERCOT's large load interconnection, and they're tracking 56 gigawatts of large load that could connect by 2028. They've approved planning studies for 15 gigawatts of this large load by 2025. I could probably have 10 slides that go over all of the different markets and the alarms that they're sounding, but here's another example from PJM in their load forecast report. In 2023, this is their projection for load growth. 2024 is green. Blue 2023, this is a 1 year difference and represents a 20 gigawatt bump in projections than just 1 year by 2038. What's this all mean? Well, dispatchable capacity is delaying retirements. We've seen decommissioned nuclear facilities being re-energized. And I would assume that thermal capacity additions are going to start getting announced because whenever renewables don't show up, we need some sort of firm capacity to meet this demand. With that, we are going to move on to West Texas and start talking about a specific example with gas and power markets.
Thanks, Alex. Well, let's get started with the Permian Basin in West Texas. As you heard me mention earlier in the presentation, Waha was, the Permian benchmark was one of those natural gas price locations that really didn't behave like the others. You saw negative pricing, as I mentioned, as early as March 6th, I believe, still in the winter season, but with not a lot of demand and all of the supply in the market, particularly in the Permian, you saw prices move to into negative territory. Now, this isn't anything new for the Permian. However, this actually dates back to 2019, which is the first time that we ever saw negative pricing in the natural gas market. But around that time, we had upwards of 8 BCF per day of Permian supply in the market. Not enough pipeline capacity to move it, though. And so you saw prices fall below zero for the first time ever in the spring of 2019. And of course, that was ahead of Kinder Morgan bringing online their Gulf Coast Express pipeline. Now, since that time, we've kind of seen this whole scenario play out multiple times again. We saw it ahead of Permian Highway pipeline coming into service. in 2021. Then later that year, we saw prices fall negative again ahead of Whistler pipeline coming online. And then even last year, when both Whistler and Permian Highway had expansions take place on their systems, we saw prices fall negative again. And of course, as I mentioned earlier, prices have been negative in the Permian for most of this year. Now, of course, it's not just supply, though, that we're talking about. Yes, there's a lot of Permian supply coming into the market, but there's also demand factors at play. And Alex, I'll let you tell us a little bit about the demand factors that we saw at Freeport LNG this summer.
Yes. So one factor that did not help West Texas natural gas prices was reduced Freeport throughput. And the graph below is showing live power monitored daily average Freeport LNG load. So live power monitors the load this facility puts on the grid at a 60-second basis. First, this facility is a large load on the grid. It's near 700 megawatts at full operations. Second, this facility has had a tough go at it from an operations perspective, pretty much from the get go. And 2024 is no exception. In January, Winter Storm Heather damaged some equipment, leading to some of the trains dropping offline. By mid April, the facility dropped completely offline. By mid May through July, the facility was back to normal operations. And then Hurricane Beryl came along and hit the Texas coast. The facility ramped down in anticipation of the hurricane coming to the coast, and it took 15 days for a return to service, return to full operations. With an offtake of 2.1 billion cubic feet a day, when this facility is offline, it puts a significant downward price pressure on natural gas prices. And with a surplus of natural gas available in West Texas and deliverability issues getting it out of the region, whenever Freeport is offline, this is very correlated with downward price pressure on West Texas. So we're seeing increased gas production in the West, and one of the grid impacts of that is that oil and gas activity is one major factor driving load growth in the ERCOT West zone. I'm sure many people have heard of the Texas load growth trend. It's been ripping the last couple of years, but you may be surprised that West is driving ERCOT total load growth since 2023. On screen, I've got the year-over-year growth change for the West Zone in orange versus the rest of ERCOT in blue. So from 2023, West Zone took over as the leading load growth. In the last 12 months, we're seeing it almost make up the majority of load growth. And I know these numbers don't jump off the page on a megawatt basis, but total West Texas load currently sits at 7.4 gigs in the last 12 months. It's grown 40% in the last 2 years, and it's doubled in the last 6 years.
Well, there at least is good news coming to West Texas. We do have more natural gas pipeline capacity coming. Matterhorn Express, that pipeline began operations in early September. Now, that pipeline is brought to you by the same developer as the Whistler pipeline, so Whitewater Midstream. And so, this is a huge pipeline, 2.5 BCF per day, coming to, out of the Permian and moving that gas towards the Katy area, which is near Houston. So it's a huge pipeline and it's going to take a while to fill. We have started seeing some incremental volumes already taking place on that pipeline, moving on that pipeline, but really it's going to take several months until we actually see that full 2.5 BCF per day coming into the market. We're kind of pegging that usually based on the timeline of other pipelines of similar size. We're thinking around 6 months or so for it to fully fill, which puts us at around, maybe like the February timeframe, which would be great if there is a winter this year. Um, but that said, even though we're starting to only see incremental volume so far, Matterhorn has actually had a very positive, supportive impact on the natural gas market. As I mentioned earlier, Waha prices fell below zero in early March, and really from the beginning of the year through September, prices there have averaged at negative 65 cents. Now, we did see prices start to improve once Matterhorn came online. And from mid September through October 4th, prices at Waha have actually averaged at positive 66 cents. So you've seen a huge improvement of $1.30 in just a matter of weeks.
So West Texas actually presents a similar challenge for gas and power markets. And so for the power perspective, the West has low population, it's got low load, and was primed for plentiful renewable build out in the future. So back in 2005, ERCOT identified this and announced the competitive renewable energy zone transmission lines known as CREZ, and they brought them online in less than a decade. So the goal of this was to bring generation from the West to population centers in the center of the state. Now, with the West Texas load growth that I just discussed, this trend has reversed, and they're projecting another 27 gigawatts of future West Texas load growth, which has resulted in a reliability plan being being proposed by ERCOT. So, what makes up those 27 gigawatts? Half of it is going to be oil and gas related load growth, or 12 gigs is oil and gas related. The other 12 is going to be large load like data centers and crypto facilities. And so, what are they going to do? They're building transmission again. And so, they're now building it for the opposite reasons, which is to bring power into the West from other zones. This plan has even gone as far to propose the first ever 500 kV and 765 kV transmission lines in the state. Whether those get built and that plan is executed is to be seen, but even the proposition of building 500 kV and 760 kV in the state is a signal that the load growth is still to come. So this is the same point, but visualized from a price perspective. The lack of transmission in ERCOT has driven West Hub to a premium versus other hubs. I've got the power price basis to North Hub down below, Hub West in blue, and positive values would indicate that they are at a premium price to North Hub. And so in the last 12 months, Hub West is the highest priced hub in ERCOT. And this is quite the reversal from the way things had been pre 2023. 2022 and beyond, I could extend this graph out many years. Hub West was the lowest priced hub in ERCOT. So load growth is creating quite the change when it comes to how I guess, how congestion is affecting prices at different hubs.
So, in the natural gas space, what's next for the Permian? Well, as Alex mentioned, oil and gas activity is driving a lot of the prices and the activity in West Texas, and so we are going to see a lot more gas production. If you take a look at the lower right-hand chart, you see that Criterion Research is projecting 2.4 BCF per day of additional Permian supply coming into the market by the spring of 2025. And that's just for next year. Projections for the Permian are very positive. It's a very positive outlook there. Gas is expected to continue growing. And midstream companies, though, are ready. They're chomping at the bit, waiting for a piece of that Permian pie. And so they've got several pipeline expansions that are under development. Not all have reached final investment decisions yet, but there are several pipelines here listed that I have bulleted out. Obviously there's going to be a lot of demand coming. We mentioned the LNG facilities coming online on the Gulf Coast. We have the data centers, so the demand is going to be there. But if you take a look at the bullets on the lower left-hand side, it's not just on the Gulf Coast and in West Texas where we have that demand coming. These pipelines listed in the lower left are actually targeting South Texas because a lot of that gas that's going to be moving to South Texas is then going to be transported into Mexico, where then that gas will be liquefied and re-exported as LNG. So again, lots of demand for Permian gas, not just here domestically, but in Mexico as well. So, what kind of impact will this have on Permian gas prices? I think the big question that everybody always wants to know is, okay, now Matterhorn's online. Have we seen the end of negative pricing in the Permian? And if you take a look at this forward chart, you would think that, yeah, maybe the days of negative pricing in the Permian are behind us. We do still see some variation in prices. As I mentioned, uh, we are going to still see a flood of supply coming. It looks like prices may dip down to that $1.25 range in the spring of 2026 as we await the next big pipeline coming into service. But generally speaking, the forward curve seems pretty positive. However, I will say that if history has taught us anything, going back to 2019 at least, that negative pricing is always a possibility in the Permian. There are obviously always risks to any outlook. And I will say that our forward prices are meant to be indicative in nature. They are not an actual forecast of where prices are expected to be in the future. They are just indicative. And so, producers may bring on more supply than current estimates are projecting. We may also have some pipelines that don't FID, that don't have enough customer interest. So, leaving some pipelines out of the market. There's also just other delays, regulatory delays, labor delays, anything. There's lots of risks, of course, in the market. And so obviously our team of market reporters will be keeping an eye on all of that and seeing how those supply and demand fundamentals take shape for the Permian. Now, wrapping up, we did want to spend just a few minutes talking about the Northeast. Really, this is just another region where you have a lot of uh, similar constraints going on. The main difference here, well, a couple of main differences in the Northeast is that we don't have projections for stronger output. Production has kind of topped off at about 33 BCF per day back a few years ago, but we've really struggled to hit that level again, and we see it softening, and that's largely because there isn't enough pipeline capacity to move that gas to market. And the difference with the Permian, though, is that there's not this large queue of pipelines under development. In fact, we recently just had this summer the Mountain Valley Pipeline come online. That was 2.5 BCF per day that came into the market. And a lot of people have opined that, hey, maybe this is the Northeast's last big greenfield project. Notably, Mountain Valley Pipeline interconnects, it hits Transco at station 165. And because there are constraints further down that pipeline, you're not really able to realize the full potential of MVP just yet until Transco does do some expansions. And so that's the one thing that we want to note here is that, given the harsh regulatory environment and the difficulty in getting pipelines built in the Northeast, a lot of the big pipelines that are already in the ground are instead doing big expansions in order to move that supply to market. And so really, we don't see Mountain Valley Pipeline filling to its full capacity until 2027, which is when some of those Transco projects will be online.
Yeah, I guess this is a good time to point out that Station 165 is available in Yes Energy to joint Yes Energy and NGI customers. Transition here. So the limited natural gas pipeline in the Northeast, specifically New England, has created an interesting dynamic. I'll give a quick overview here where the prices spiking coming up Algonquin and limited natural gas deliverability has actually propped up oil generation in the Northeast. It historically had a bunch of oil generation that was replaced with gas, but no pipeline investment was made to, you know, significantly increase natural gas deliverance up to the Northeast. So or I guess New England in this situation. So what happens? Well, there's a large dual fuel nature as a result, where facilities can run on gas or oil as a backup. So on these cold days, whenever the price spikes, a lot of facilities will actually switch over to oil. And that creates an interesting dichotomy for single fuel natural gas plants. Single fuel natural gas plants are faced with a choice. Do they procure gas and risk not clearing the market where oil is actually way more economic to run? Or do they not run at all? And that's kind of what happens is that single fuel facilities choose to leave themselves out of the equation on cold weather days. And for days where there's operational flow orders that are affecting firm transport, this makes a lot of sense. But for a large majority of cold days, it's simply the fact that they take themselves out of the equation. So the graph that I have below is looking at a capacity scarcity condition in New England ISO on December 24th, 2022. And it's breaking out what was offline in the hour that they had the condition. And over 50% is single fuel combined cycle facilities, followed by dual fuel combined cycle facilities. Something to keep an eye on as we come into winter this year, because this dynamic has not changed.
And so, of course, what does that mean for the natural gas market? Obviously, I think we can expect to see continued volatility in that region with, no new pipelines coming into the market. Of course, that leaves the market vulnerable to periods of strong demand where you need the natural gas to keep your homes and businesses warm, but not enough pipeline capacity to actually get it there. And so we do expect to see some seasonal volatility continue in that region. A little bit less so after 2027, which is when Transco is expected to have those expansions online. And generally speaking, prices in the region will tend to follow the general, trajectory of Henry Hub, for example, but with more seasonal volatility in those winter months. And with that, I think that wraps up our presentation. Few key takeaways. We won't go through all the bullets, but we did want to provide you just a high level overview of some of the things that are driving the natural gas market, what have been driving it this year, and what we'll be looking forward to next year. For the natural gas sector, that of course means production. That's going to be the big thing that we'll be watching. I think we pretty much know the demand is going to be there, but how producers respond to that demand is something that we at Natural Gas Intelligence will be watching.
Yeah, and from a power perspective, the big takeaway is solar could shift peak volatility to winter grid operations. And as other ISOs start to build out solar, this is something to keep an eye on. Lastly, West Texas isolation. It's providing challenges for both gas and power. And with that, we'd like to thank everybody for attending, and we will open it up for questions.
Let's see, I'm going to take a look here in the chat here. And let's see, Alex. Well, why don't you tell us a little bit? I think we have here, tell us a little bit about how you're gathering that Freeport LNG data.
Yes, so our live power product offered through Yes Energy is a real-time grid transmission and load monitoring product. So we have patented magnetic sensors that we put up next to major transmission lines, and we actually measure real-time power flow. So In the case of Freeport LNG, we are monitoring all of the power lines into the facility on a 60-second basis, and that allows us to provide a load estimate for the facility in near real time. And it doesn't stop there. For really anything that is load related connected to the grid, we can go out and monitor that, and as well as generation and transmission all around the United States. And it looks like I've got a question here for Letty. This question says that it appears gas prices are expected to be relatively low for the next 10 years. Save for few key regions you discussed, what's the biggest risk to the outlook?
So I think the biggest risk to the outlook for the natural gas market, and if we're talking strictly about fundamentals, I mean, I would say that weather is something that, you ask any reputable meteorologist that any weather forecast that goes out beyond like 2 to 3 weeks, it's just that it's a forecast. It's really not something that could be taken as fact. And so right now, if you look at the weather models and you're looking at the, December through February timeframe, it looks like we might be in store for another warm winter. There are some areas that kind of have an equal chance of being, hotter than normal or warmer than or colder than normal this winter. But generally speaking, that's kind of the biggest thing that can really change the market, even if it's just temporarily. Now, we saw, the prices in January immediately jumped to more than $13 at Henry Hub. And that's just with one winter storm. We got really lucky last year with a really warm winter, and we had a warm winter the previous one. It's important to note that even if we are still warmer than normal, but if we're colder than last year, for example, that can have a huge impact on prices, and especially if we have more demand coming from LNG, from that Plaquemines LNG facility and the Corpus Christi Stage 3. If we start seeing more significant volumes there, you get a couple of cold spells, and we could see prices, really escalate rather quickly. And then you couple that with a couple of freeze offs, and that also I should mention, it's not just the Rockies and Appalachia that see freeze offs. We also see freeze offs in the Permian. So really, there's a lot of factors at play, but really weather, I think, is, such a dominant one in the natural gas market. And so that's always, I think, one of the biggest risks. Let me see if we have, I'll find one for you. Here's one on West Texas, Alex. How does load vary throughout the day? I think you did kind of touch on this in your presentation, but are there any specifics as far as how we see the energy demand fluctuating?
The load curve is for the West Texas zone is going to be very similar to ERCOT total. If I break it out by zone, you're going to see load starting to increase in the morning with the morning ramp, and the second that the sun rises, we're going to see. Well, I guess I'm thinking from a net load perspective. So load's just going to be a curve that's going to go up, peak in the middle of the day, and then drop off at the end of the day. Whereas net load is going to then start to diverge as solar rolls onto the grid. But from a load growth perspective, I will point out that West Texas has got a lot of land. It works for obviously oil and gas with oil formations down low. It works from a grid perspective of renewable generation build out. It's good for solar. It's good for wind. And that makes it a prime place for batteries and large loads connecting to the grid. So we are seeing a lot of crypto facilities co-locate behind the meter with gas plants. And there's even more load growth in the future that's coming from this kind of commercial large load that is connecting to the grid.
Yeah, and that
And so,
actually brings up. Oh, go ahead.
go ahead, Letty. Sorry.
Sorry. No, I saw another question in here that actually touched on that. We have, can you elaborate a little bit more on why the data center demand really hasn't shown up in the gas forward curve much? Has the market already taken that into consideration? This one is difficult because, like I said earlier, the kind of the jury's still out. We do know that data demand center demand is growing. That's a obviously that's obvious in the market. However, a lot of these demands data centers are looking to renewables to supply their energy, and so that's why we don't really have, you've got estimates all over the place. I mean, in the early days when we first started hearing about data centers late last year, we saw estimates of up to 20 bcf per day just from that sector alone for the natural gas market. Now that the hype has kind of died down a little bit and people have a more firmer grasp on what that actually means for the natural gas market, it's more around the 5 to 6 bcf per day uh level for demand. And so, as I mentioned, always say that forward curves are what the market sees now, as far as what they're projecting now for the future. We don't really know exactly how the demand center sector will play out, how much gas demand is actually going to be in use. And so that's why I say, it's not necessarily a forecast, it's just an indication of where prices could end up. But I think we could obviously see some upside to that if we do see demand come in maybe even stronger from data centers. However, there's also the production side of that. If you have stronger demand, then you're going to have producers ramping up. So it's a delicate balance, and something that we're definitely keeping our eyes on.
Great. Well, we've run up on time here. If we did not get to your questions, Letty and I will be following up to answer every question that was asked. We have quite a lot in here, and we would like to thank everybody for attending today, and have a great rest of the week.
Thank you all.